I know a lot of you are interested in backtesting trading strategies. Rightly so. Out of the 7 to 8 figure traders I've met, they have all backtested stringently. And you want to know the secret? They use this 6-step framework every single time. I'm Unbiased Trading, and let's get straight into this. The first step is to come up with a hypothesis for your trading strategy. What is the core idea behind your strategy? What are you trying to achieve? For example, your hypothesis might be that you're buying stocks that have just recently broken out of a resistance level, or you might be having a hypothesis that you can profit from shorting stocks that are overbought. So this could be a high pre-market gap percentage, for example. Also, a lot of these hypotheses either come from mentors, online reading blogs, different kind of newsletters, or even YouTube sometime, or it's just through general experience, and you've seen this happen so many times, you actually have a general idea of what the pattern recognition is happening, and then you are going to use this hypothesis to actually, backtest that idea. Once you have a hypothesis, you need to quantify it. This means turning your hypothesis into a specific criteria that you can test. For example, if your hypothesis is that you can make money by buying stocks that have recently broke out of resistance level, you might want to quantify this by defining a specific resistance level and a specific holding period. So what I mean by this is, first you need to quantify what is actually a resistance level for you. Is this like 4 recent highs that are just with high volume and they haven't been broken above in the past 20 bars, for example? Or is it just a simple kind of trend line? Have you done a quantification for how you would create that trend line? Is it a resistance level, maybe a MA? I've seen many people use kind of like Bollinger Bands as resistance and buy levels. So you could say that if it hasn't gone over the recent Bollinger Band for 100 bars, then that's a resistance. And once it does break above, that's the breakout level, for example. So there's multiple ways to quantify these kind of ideas, but you need to have an idea of how you're going to actually systematically test this idea. The next step is to gather data that you need to test your strategy. This data will typically include historical price data, but it may also include other data such as obviously volume, volatility, technical indicators, sometimes even fundamentals, so earnings, things like that. The quality and quantity of your data will have a big impact on the results of your backtest. So it's very important to use high quality data that covers a long period of time. Ideally, I'm always looking at around 5 years of data, and my particular data sources are normally either Polygon or FMP, and most of those are quite affordable to most people if you do know how to code. If you don't know how to code, then you can always hire someone to help you kind of write that code, whether that be me or anyone else. Once you have your data, you can run a simulation of your trading strategy. This means backtesting your strategy on historical data to see how well it would have performed. Now, there are a number of different ways you can run a simulation. You can do kind of like a basic version in Excel. That can also always be a method. You can use dedicated backtesting software. So I know there are a couple out there, and for particular niches, it can be really useful. So like in futures, you can technically create a strategy through the NinjaTrader strategy creator. I personally don't like it too much, but I do know some people that are really good at it. And if you can't code, then that can be something that potentially could help you. But I've just always resorted to coding, as that's normally been the most efficient way to get my idea straight into a strategy, for example. And that brings me on to my last method, is you can use something like Python or C# to fully create your own backtests, or have someone create your own backtest as well. Once you have run a simulation, it's important to test the robustness of your strategy. This means testing your strategy under different market conditions with different parameters as well, when we're talking about parameter sensitivity testing. For example, you might want to test your strategy under different volatility conditions, or even different holding periods based on, are you waiting until end of day for an exit, or are you going to have like a 2-hour time limit until you exit, for example. This is normally known as parameter sensitivity testing. You're trying to see how much a slight change in your parameters are going to affect the performance. And ideally, what you want to see is that slight changes in your parameters most likely will make your strategy a bit worse, but they're not destroying your edge to where you're making no money at all because you've changed it from 55 to 52, for example. Something like that would be quite dramatic, and that isn't really a good sign. And then the other side of robustness testing is mainly Monte Carlos. So the one that's on screen here, where we're running, thousands of different simulations, reordering your trades to see over all of those simulations, are you consistently coming out profitable with this strategy? And this is very useful because in the market, the distributions of wins and losses isn't set in stone. It's not uniform. So knowing how all these different ways could play out, but it's still most likely to end up profitable, is very key to actually understanding your strategy is robust. The final step is to evaluate the results of your backtest. This means looking at the things like average return, the maximum drawdown, the win rates. You should also consider the risk to reward ratio of your strategy. And overall, the idea here, I think many people oversimplify evaluation. Even when you're going with algos, there is going to be psychology involved. I know I did a recent post that got a bit of heat from some people where I was saying psychology is a bit of a hoax or is presented as the ultimate savior of your trading. Really what I was going over in that post was saying that I personally think it is more important to focus on edge over psychology, not that psychology isn't useful at all. And a really big component of this is even someone put in the comments, which was on my side, but he was saying, algos don't need psychology, and that's really wrong, to be honest. When you're running an algo, you're going to have the psychology of, oh, should I stop it? It's lost for a week and a half, and I don't really think this is, holding to my backtest. I don't like the idea that I'm just losing money for the past week. I'm going to stop it, maybe change some things, then rerun it, for example. There's all those kind of things that come into it. And I love the way Kevin Davey put it, where the psychology of having an algo isn't about the particular trade. It's about the particular strategy. When you're not running an algo, every one of your psychological decisions is about, should I take this trade? I'm a bit hesitant, or, I've just lost twice in a row. I'm going to oversize on this one because I need to make back those gains. You don't have any of those issues, but you have all the other issues that come around with just running a strategy in general. And I think for most people that actually have run algos, they understand that there is actually still psychology involved, and there is still, quote unquote discipline, and different ways you can try and handle that. I just have always tried to paint the picture that edge is more important, but psychology is something that is ultimately always going to be needed in trading, even if you are running algos and you do need to improve your psychology. I've just found that it's always easier to improve my psychology when I have more and more confidence in the strategy itself. And to be honest, when I first started trading, I had the least amount of confidence because I had no experience. I had no right to believe that I knew what I was doing. And I had no data. I had no right to say that I knew a way that I was going to make money or really have edge. So all of those hesitations, those emotional outbursts came from a place of being so uncertain. It was very difficult to have a stable psychology. Now, once I was able to be a bit more certain, because I knew I had at least an idea that this strategy should be profitable over the long term, then those emotional outbursts became smaller, at least for me personally. Now, I can now happily say that from doing the How to Backtest Bootcamp, I know other people do benefit from this as well. For a while, I thought maybe it's just me, but I see other people doing the same kind of things I do. I don't think I'm really unique. I've stolen so many things from people here and there, and I think all kind of traders have. So originally, that's kind of just bringing me back to the point where evaluation is really important. You need to consider your own personality type in trading. You need to understand your own risk limits. You need to understand if I'm going for this strategy and I've just backtested it and it has huge volatility, it is constantly going up and down, huge drawdowns, but it's making so much money. Could you actually handle that? In the reality, for most people, they couldn't. They'll end up breaking. They'll end up oversizing on just one trade because they've lost so much money from this huge drawdown. And those kind of things really come into play, which will break any strategy ever. So that brings me to pretty much the last point. If you are interested in backtesting, I am still running the September Backtest Bootcamp. I'm pretty much full, but I have had some other people say they really want to join, so I might open up a couple slots. If so, message me on Twitter, or you can sign up to the email below and go through that kind of process of understanding what the bootcamp is about and if it's right for you. Thank you for watching, and if you enjoyed it, please like and share it with anyone else who might be interested.